This conference will now be recorded.
Hello there. This is Joseph Tritola. How are you doing? We are going to look at how to analyze replacement scenarios for the final expense agent, whether you are a field agent conducting business face to face or whether you are a telesales agent conducting business over the phone. This very brief module will give you a cursory look into trying to understand when replacements would be appropriate for your clients and your prospects. Just a few disclaimers I want to go over very quickly. This is not intended to replace any carrier-specific training. It is meant as a guideline only. You, the agent, are ultimately responsible for knowing all the rules and regulations. The presenter, which is me, I am not affiliated with CMS, Medicare, Medicaid, United States government, or any of the other things you see there. This is going to be white labeled, so uplines and agencies, you can use this to help train your agents. We are not endorsed by any of the above. It is assumed that you have permission to call your leads, and it is well documented. You are not violating any DNC rules or TCPA rules. Always refer the client to Medicare, Social Security, or their local Department of Social Services for any information pertaining to financial support for health care. And for the purposes of training, we do not endorse, recommend, or steer towards any specific insurance company that may come up during the training. Mentioning of any carrier is strictly for illustrative purposes only. Now, what you're going to want to do is you're going to want to work backwards, not forwards. Now, here's what I mean by that. Most agents will generally ask the applicant, if it comes up in conversation and the applicant says, well, I already have life insurance, most agents will ask the applicant, well, how much coverage do you have and how much does it cost you? The applicant will sometimes provide the information. Then they'll go to their quoting tool and they'll see that they're unable to beat that price unit versus unit. And this generally ends the conversation. And what I mean by that is the applicant has $10,000. They're paying $50 a month. You go to your quoting tool, your absolute lowest carrier for $10,000 is $70 a month. Right then and there, you as the inexperienced or agent that just doesn't understand or doesn't know replacements or how to analyze replacements will end the conversation right there and it's over. And that happens all the time. That is probably, in my opinion, 2/3 to 3/4 of the conversations. When somebody says, I have insurance, the agent says, what do you got? Insured tells them, agent says, uh-oh, nothing I can do. Problem is most of you are not properly trained to analyze that. And I hope as a result of this module, you will have a better understanding and a better way to properly help and advise your clients. There's also a few guidelines you have to follow. And these are certainly not the rules. I would think maybe one of them is more of a rule, but there are certainly guidelines you have to follow. Number one, it is usually not a good idea to replace an in-force level policy with a guaranteed issue or a modified. Modified is essentially guaranteed issue with some health questions. I really can't think of any scenario off the top of my head where this would be considered in the client's best interest. It would have to be an extremely unusual circumstance. As a guideline, we suggest to stay away from this practice. Now, here's what I mean. You've done your health assessment with the client. The client tells you that they're on kidney dialysis. You know that kidney dialysis only means guaranteed issue. They already have an enforced level policy. You generally would not replace that with your guaranteed issue, especially with that type of health condition. So again, I can't think of any reason where you would replace GI over a level or modified over a level. If you're replacing a level policy with graded, you need to be sure that you have fully documented why this is in the client's best interest. Now, a graded policy is a lower rank policy than level. Level means that the benefit pays out in full first day coverage. Graded means is that as time goes on, a percentage of the death benefit would be paid out as a death benefit. So if you have somebody that has a $10,000 level policy and you're looking to replace it with $10,000 in graded, well, if that person drops dead, in your policy, their family is only getting $3,000. If they drop dead in the policy they already have, they're getting 10,000. So it would have to be a very unique or unusual situation where you would replace, where the person may have a $2,000 level policy and you're replacing them with a $10,000 graded policy. And then in that case, of course, the graded death benefit of 3,000 if they drop dead today will far outweigh the 2,000 they would get in their old policy. So it has to be a very specific scenario. Just as a guideline, you want to be extremely mindful of this, and you want to make sure you have well documented why this is in the client's best interest. And then always do a health assessment to determine if a new policy is an option. And that kind of goes into the first one. So what do you need to do when they already have an existing final expense policy, or any life insurance policy for that matter? First and foremost, the obvious. You want to gather very specific information about the policy. Now, the easiest way is to ask to see the policy, or ask the prospect to go get the policy if you're doing telesales. Now, if you're already in the house, it's a little bit easier for them to go into their bedroom and dig through the junk drawer and grab the policy if they know where it is. If you're on the phone with them, that's asking them to do a job. And when you're asking somebody to do a job, especially when they're not getting paid for it, it tends to be daunting and it tends to be burdensome. So that generally will not be probably your more successful route. If you leave it to the client to terminate the call, to get back to you when they get the policy information, you might as well just say goodbye to them as they're departing on a lifelong cruise around the world. You're never going to hear from them again. The minute they hang the phone up, life will immediately supersede or come ahead of what you're doing. What I suggest you do, always, what I suggest is that you get the insurance company on the phone with the insured. Okay, it's a very quick phone call. You be very polite and say, do you mind if we call your insurance company? I would prefer to ask them the specific questions so that we can properly analyze your policy. And here's the information you want to ask for each and every time. Number one, you want to ask for the policy date. The policy date will tell you whether or not this policy was put in force within the last 2 years, as it's still in the contestable period, how old the policy is, things of that nature. Next thing you want to ask is what type of coverage the person has. You would be surprised how many people are convinced they have whole life, but in actuality they have term. So you want to ask that type of coverage. You want the applicant to hear the insurance company tell them what type of policy they have. I remember not arguing, but debating with a customer. They were trying to tell me that their rate was X for the amount of coverage they had, and there was just absolutely no way. After some debate, I finally got them to agree to contact the insurance company with me on the phone. I asked these exact questions you're seeing here. By the end of the call, he had apologized and asked what he can do to get out of the policy. He was under the impression it was something that it wasn't. You want to ask the face amount. Another name for the face amount is the death benefit. Not to get you all too confused, but the face amount is what the policy is issued at. The death benefit amount is what the policy will pay out as. Oftentimes it's the same number, but if the person has a loan on the policy, the death benefit will be less than the face amount. So I use those two terms interchangeably, but they don't mean the same thing. They are the same thing, but they don't mean the same thing. The next two, cash surrender value and cash value, you want to ask. Cash surrender value is if they cash the policy in today, what would they get? Cash value is what's the value of the policy of their cash. Sometimes those numbers are different. If the cash surrender value is different than the cash value, well, that means that there's either a loan on the policy or a surrender charge. And if you ask the cash surrender value, and then the next question you ask is the cash value, and if they tell you anything different than the same, then you know to ask whether or not there's a loan or whether or not there's a surrender charge. I generally, as a rule, ask if there's a loan. I don't ask if there's a surrender charge unless those two numbers are different. But even if the two numbers are same, I still ask if there's a loan, because sometimes you'll get the death benefit to be a little bit off. Instead of 10,000, it might be 9,000, $812. And I mean, I already know what that means. That means that the client missed a few payments and they put those payments into the automatic premium loan provision. But again, you want the insurance company to tell you this because you don't want to make any assumptions. The next thing I like to ask for is what is their premium payment and their last payment received. Now, this is valuable information because number one, oftentimes people don't realize what they're paying. Like they really don't. I had one client that was under the impression she was paying 40 a month. The insurance company on the phone, it was 70. They just don't know. Second thing is you want to know when the last payment received is, or when it was due, is because if you're going to do a replacement, you want to do the timing of the replacement so that the person doesn't have to pay two premiums in 1 month. Lots of these people are on fixed incomes and they don't have the means and the resources to float two premiums in 1 month. So when you ask when was the last payment received or due and they tell you it was March the 1st, then you know that your next transitional day can conceivably be April the 1st. And that's kind of be what your target is. And then, for the more experienced agent that's out there, sitting with people outside of the traditional Table D final expense, simple issue stuff. If the client has a UL, a IUL, a GUL, a whole life, a VUL, anything other than, final expense life insurance, you want to ask how long the policy will remain in force under current premium payment mode, interest rates and amount. So that's generally published on the annual statement of these policies, but I always want to ask that question. And then depending on, and again, I'm going a little bit off here, but depending on how deep you want to get into the UL or the IUL, it's always good practice to run an in-force illustration. So what we're going to do is we're going to look at a scenario where you have an applicant, and we're going to look about how we're going to help the scenario.
This conference will now be recorded.
Okay, so we have a scenario. John, who's age 70, is a Florida resident. Currently owns XYZ whole life. He bought at age 55. The death benefit is $10,000. He's paying $50 per month in premiums. He has built up $2,000 in cash value. You had contacted the insurance company and his reduced paid up amount is $5,000. There are no loans or surrender charges. So I created this easy to use tool here where as you're on the phone with the insurance company, you can type in the various different scenarios and it populates it over in the columns where it is. Sometimes people have two policies, and what it will do is it will add the numbers up for you. Okay? So the first thing you're going to do is you're going to look at scenario number one, dollar for dollar change. So scenario number one, we run some quotes, and again, I'm not endorsing any of these insurance companies, but I ran a quick quote and I decided to take not the least expensive one, but I just made the assumption that this individual qualified for this carrier right here. Okay, no rhyme, no reason. It's just the one that they qualified for. So I wanted to use a higher number. So for $10,000 of coverage for this 70-year-old male today, it's going to cost $73.31. All right, $73.31. So when we go back over to our slide over here, to replace that policy, a new $10,000 policy will cost $73.31. Is $73.31 in the client's best interest for $10,000 when they're already paying $10,000? Dollar for dollar, the answer is no, absolutely not. However, if the client does take out this policy, they would receive a refund of $2,000. And that would be their cash value. So I'm not insinuating that this is a good scenario. I am just showing you that you want to start with the most obvious scenario, and that's a dollar for dollar replacement, and see where that brings you to. The second scenario would be you decide to exercise his reduced paid up amount, and we know that's $5,000 because that's what the insurance company told you. And you ran a quote with the same insurance company, and the quote you ran for was for $5,000 because 5,000 plus 5,000 equals 10,000. So he has one insurance policy that's reduced paid up to 5. You sell him a second insurance policy for 5. So together he has 10,000. Look at the premium, $38.97. So you go to your tool. I got to take that off. All right, so you go to your tool. Just bear with me. Okay, and you put in the proposed death benefit of 5,000, the reduced paid up of 5,000, and his new premium of $38.97. And look over here, Mr. and Mrs. Client, for no change in your premiums. I'm sorry, no change in your death benefit, Mr. and Mrs. Client. I can reduce your premium by $11.03 a month. So you'll have the same amount of death benefit. However, you will be paying less for it than what you're currently paying now. So that would be scenario number 2. Okay, scenario number 2 is keeping the same death benefit and reducing the premium payment amount. Moving on to scenario number 3, you have to think this policy was bought 15 years ago. $10,000 was worth something then. Inflation makes all the reasons people buy these policies increase. So scenario number 3 is where you try to use the same premium that this applicant is already paying. Okay, you're never going to hit the nail on the target to the exact dollar amount. You might be a few dollars under or a few dollars over, but you want to try to stay right within range. I don't really see much of a difference of $50 versus $52.70, not in today's day and age. But look what happens. Reduced paid up, we know, reduces the current policy to $5,000, gets rid of the premium because it's reduced paid up. We sell them a new policy for $7,000. 7,000 from plus 5,000 is now 12,000. So let's go take a look and see what the spreadsheet does. So now we put in the scenario of the proposed death benefit of 7,000, and we raised the premium to $52.70. Now we have a presentation to the client and say, Mr. and Mrs. Client, for an extra $2.70 a month, would you like to increase your death benefit by 20% or $2,000? So in either of those two scenarios, scenario number 2 or scenario number 3, I can't think of any reason why a client would not want to pick one of those two scenarios. I have $10,000 of coverage I'm paying $50 a month for. You can do the same thing by restructuring my policies and save me over 20% of my premium. Or I have $10,000 of coverage. I'm very happy paying $50 a month. For roughly the same amount of premium, you can increase my coverage by 20%. Why wouldn't I do that? So the question that you and your client have to decide is whether or not which of those two scenarios would be better for you. So the question I would always ask is, which scenario seems to be in the client's best interest? A scenario number 1 would come into play, and I'm not going to discount it. A scenario number 1 would come into the play if the client was in a financial bind. Okay, if they needed money, if something was, their car broke down, whatever the situation is, they can receive a refund from their current policy, but they would be raising their rates by approximately $23.31 a month. When you do the break even, so I would take the $2,000 of what they would receive, okay, and I would divide it by the premium difference, and then what I would come up with in that mathematical a formula would be 85 months. Okay, so 85 months is approximately 7 years. So the break even, what I mean by the break even, and that is by the time 7 years comes around, when this client is 77, it would have been better for this client to have kept their existing policy. If the client died at any point between age 70 and age 77, cashing in the policy would have posed to have been a better economic decision, somewhere between ages 70 and 77. If he lives past age 77, keeping the original policy would have been a better economic decision. And this doesn't include time value of money. This doesn't include the refund being invested, just straight dollar for dollar. So although scenario number one is generally not the more ideal situation for a replacement, it can be used in certain and unusual based circumstances because the client would get a refund of $2,000 here. I don't suggest you lead with this one. I do suggest you do analyze it for your own purposes so that you can truly see what's going to be in the best interest of the client. When you plug in that scenario, proposed death benefit, $10,000. There's no reduced paid up because you're cashing it in. Okay, the client's going to get $2,000 cash back, and their rates are going to be, I think it was 73.31. Okay, so they're basically getting the same death benefit for $23.31 additional. Okay, if they were going to take the $2,000 and put it in a savings account, which I can tell you they never do, they would be basically picking up $2,000 more of death benefit for $23.31. It probably would be less expensive for them to just purchase a $2,000 policy. I know I kind of went off a little bit, but in essence, scenario number one should only be used in unusual circumstances where the cashing in of the policy would be gravely needed in the scenario of the client. So you certainly want to always look at it. I find to use this tool to be very beneficial when doing a scenario where reduced paid up amount or cashing in the cash value. There are some scenarios where cashing in the cash value would make sense. Again, it's all about going through and putting the numbers in the tool and determining whether or not the end result is in the client's best interest. So scenario number two, does it make sense to pay $11 a month less in premiums for the same coverage? Or scenario number three, does it make sense to pay just about the same, just about the same and get quite a bit more death benefit? So that's how you analyze a policy. The agents that become a mastery at this tend to sell a tremendous amount more business, especially when it's in the client's best interest. So what are the risks of replacement? And I think this is important for us to spend a couple of minutes on. Number one, you have to be mindful and aware that a new suicide and contestability period begins. Okay, so you got to be really sure that when you're participating in a replacement, that you're not walking in the gray with these clients when it comes to their medical. It's got to be black and white. You know, they either, positively can get the coverage or they positively cannot. The other thing you want to do is you want to be mindful of tobacco rates versus non-tobacco. Now, why? You'd be surprised out there. An applicant may have been rated non-tobacco on their existing policy, and they are actually tobacco users. And what I mean by that is, it happens a lot in our industry where an agent will clean sheet the applicant as non-tobacco, the policy gets approved. Fast forward, here it is 10 years later, and they're paying these, very low non-tobacco rates. So you got to be mindful. I'm not saying that if you come across somebody that has a non-tobacco rated policy and they're sitting in front of you smoking cigarettes, that you're going to be wasting your time helping them. Just things to be mindful about. The other thing is you want to make sure that you are the one that handles the entire transaction from start to finish. Do not ask the client to call and cancel their policy once you sell them yours. You handle this. You assist the client to cancel in writing, so there's always a paper trail. You're in charge. You are in charge. And then finally, it's very important, and this should be obvious. You should be doing this with everybody anyways, but do a very extensive health and screen evaluation. And I suggest, and I mean, this is just my suggestion, consider only using carriers that have personal health interviews. I know that there are some carriers today where you submit the application on the portal and you wait a couple minutes and it tells you whether or not they're approved. I would not recommend using those insurance companies for replacements. Absolutely not. Something could go wrong. It may not pick up everything. And the last thing you want is a year later getting a note from that insurance company saying that they're rescinding the policy. They're not going to be able to get their old one back. And now that they don't have any coverage at this point. So I would absolutely suggest you only use carriers that have a personal health interview. You're basically restarting the contestability period. And like I just said, it's the last thing you want is a recession because something was inadvertently left out on the application. All that stuff gets picked up in the interview. So absolutely consider insurance companies that do interviews. What are going to be the next steps? Very important, make sure that you have a list of the top 100 to 100 FE final expense carriers' names, phone numbers, fax numbers for quick and handy reference. We have a 3-page document that has all this. You absolutely want to learn how to use the Excel spreadsheet analyzer. You want to be able to determine if a replacement is in your client's best interest. You want to ask your manager or upline to help you work through your first replacement case, or your second, or your third, or your fourth, or your fifth, or as many as you need to do until you feel extremely confident and comfortable that you can do this at a high level. And then most importantly, do not forget to provide the client the necessary state-required replacement forms where you are conducting business. Every state's got their own rules. Every insurance company's got their own rules. You must follow them. So I hope this is very helpful. I hope you learned something from this, and I hope this helps you help more clients.